Hi, I'm Tony Sycamore, Senior Market Analyst at IG in Australia. Well, last week was certainly a week to remember as Nvidia's thumping earning report triggered new record highs on Wall Street and in European and Japanese stock indices. With the Q4 US earnings season now winding down, attention this week will return to growth and inflation data. Fed speak last week made it very clear that the Fed views the risks of easing too quickly as outweighing the potential risks of keeping rates too high for too long, which puts the focus squarely on this week's core PCE inflation data. Now, following the release of hotter PPI and CPI prints for January, the expectation is for core PCE to rise by 0.4% month on month for 2.8% annually. Now, if this proves to be correct, it would see the 3-month annualized rate increase from 1.5% to 2.5%, bouncing away from that Fed's 2% target. There will be a temptation for the market to look through the hotter than expected core PCE numbers due to the reason that much of the recent rise in the CPI report was expected to have come or thought to have come from rises in New Year prices in things such as medical and financial services, as well as an unsustainable rise in shelter costs. Let's take a look at the chart of the S&P 500 and the Nasdaq to see where they are as we start the new week. All right, so when we updated last week, we were thinking that the S&P 500 had potentially started to lose some upside momentum. Of course, that soon was erased as Nvidia's earnings report saw the Wall Street markets, in particular S&P and the Nasdaq and the Dow, all pushed to new highs. Now, what I think we need to see happen for the S&P 500 to signal a turn is to break down through the lows of February, which comes in around 49.15. You can see there is some uptrend support coming in from the October low. It did look below there briefly last week. It didn't like it. However, the Nvidia's thumping earnings report saw that put to an end there. But we have some uptrend support coming in just above 5,000. For me, the real number probably is a little bit lower, somewhere around 49.15, which picks up these lows through February. Until then, we have to allow for the rally to continue on. And this has been something we've maintained. We haven't had a short signal at any point through here. We have been cautious. Admittedly, that hasn't played out for us, but we haven't been advocating shorts. And that remains our case. Now, if we were to see a break below 49.15, then potentially your short-term nimble traders may look to open shorts. You do need to be mindful, of course, that we are continuing to see that RSI divergence. You can see that here with prices pushing to new highs. The RSI is failing to confirm that. So something to keep in mind if you are long and if you have ridden this move up, again, probably 49.15 is a level to keep in mind, where you would probably look to trail your stop losses higher. For the Nasdaq, well, the Nasdaq, again, a similar story there. We had been watching some levels here quite closely in the Nasdaq around 17,300-ish. It popped below there very, very briefly, didn't close below there. You know, when we talk about levels breaking, we talk about on a sustained basis. Now, that didn't occur. And then, of course, Nvidia's earnings results saw it push to new highs. Again, we can see there's some bearish RSI divergence in place here. Something to be mindful of. It doesn't necessarily guarantee a turn. For me, I'd probably want to see the Nasdaq break below, let's say 17,300, 17,200-ish if you want to give it some room. Until then, you need to allow this move to continue on higher. This is starting to feel, again, like we've got more momentum building, which could see the Nasdaq push up towards 18,500, even up towards 19,000. Now, you have to let the market tell you. You have to listen and respect the price action. The price action is in an uptrend until it breaks below this area here of support, which we just mentioned. Thank you for listening and have a good week ahead.